Right, Nitin Rakesh joins in now from Motilal Oswal AMC. Nitin, morning. Good to have you in the studios. Now, what have you made of the recent weakness in the market? And there's so many triggers in this particular month. One is already gone in terms of UP elections. Then we have the policy, the budget, and of course, the global picture is still not clear. What's your call now?
I think market's clearly consolidating from the big jump we saw between Jan and Feb. So it's not a bad thing. Clearly, we needed a little reality check. In some cases, when momentum comes in, things tend to kind of run ahead of fundamentals, and that's probably what happened in the last 2 months. So I think it's a good reality check for the market to kind of consolidate and see how much of the expected reversal in macroeconomic indicators on the positive side is real and how much isn't. And I think keep in mind that we've had a very big economic event, or rather a political event, leading to two big economic events. So there's clearly a fairly high degree of anticipation, expectation, volatility ensuing from those triple events. In light of all of that, I think it's not we are still pretty well placed. We've only been we're less than 10% from recent peaks, from 5,600 odd levels. So I think it's a pretty decent showing given where we were in 2011.
So would you say that if indeed and Nifty has taken support at 200-day moving average as well, and that's also been spoken about, do you think this is it, or could we drift towards 5,000? And if that happens, would you buy, or would you get a bit worried about what's happening?
Well, that's the $1 trillion question, I would say, because I think, as I said, it's very hard to anticipate which way these economic events will go, especially the budget. I think clearly the monetary policy, there are certain expectations which probably will be met through. For example, I don't think the interest rate cuts will start given what's going on with oil prices. But clearly, I think CRR cut is likely to happen. So I think that's much less of an event, but the budget is a much bigger variable, because what we saw in the elections on the state level means that there are very few variables left for the Congress party to play with. So I think that's really a bigger event. It's very hard to say which way the market will go. It could spike, it could give you a sharp dip, given what comes out of Delhi. But having said that, I think going back to your question of what would we advise clients, I think if you look at it from from a last 4 or 5 year perspective, market's been fairly flattish, and even though earnings growth is slowed down, but the earnings have still grown. So I think the longer markets stay in this consolidation zone, the better it is for investors to accumulate and continue to accumulate stocks. I think we are not in a financial Armageddon situation that we were in 2008. So clearly, there is a certain floor below the market. We saw that in 2011 as well, when everything that could go wrong went wrong domestically and globally. So I think it's clearly a buy on dips market. You have to be very careful about what you get into, and not try to anticipate turnarounds, but rather wait for actual events to happen. So I think sometimes people tend to get ahead of these events, and that's where you have a problem of you catch a falling knife. But I think other than that, there are some very good investment stories in the market, and you should continue to consolidate and buy on dips.
But just a quick point on the budget again, Nitin. Over the past couple of years, the market has been very dismissive of the whole event, and it's calling it a non-event, fair enough. But this time around, do you think it's a little different? Because we got flows in January without hearing much from the government, and a huge amount of flow coming in. Will that money keep coming in depending on the international risk-on, risk-off trade, or will it start, will the budget and what the government is doing actually start making an impact on those flows?
I think to some extent there will be an impact. Whether we like it or not, budget can never be a non-event in India until and unless we are in a situation where budget stops being a regulatory tax exercise. As if you have stability on that front, then budget is a non-event, because then it's really an accounting exercise. But because we use the budget to also make policy changes, tax changes, law changes, customs duty, excise duty, it can never be a non-event till that happens. So I think clearly the expectation, anticipation, fear this time around is that what is the government going to do from a fiscal consolidation perspective, and which basically means that there are only two ways to do that. Either you expand revenues or you cut costs.
But will they do that? Because, the big fear that, started doing the round, got talking thereafter, the government seems to have come out quite shaken from the state elections. The question is whether they'll go completely populist, throw, everything out of the window, or whether they'll go to the other extreme and say, okay, finally we have to perform, we have to get the markets on our side, and then move ahead, which we might not have done in the last 4 years.
That's again, as I said, the $1 trillion question. And that's why it's such an important event from the point of view of, which way the wind will blow. Yes, clearly you can say that they would want to make it populist, given that they got a pretty big thrashing in the state elections. But then there is nothing happening in the next 6 months, 9 months from an election perspective. So there's little to gain from being populist right now. they can always be populist next year. They have if they're still around next year. So I think that's why it's from a sentiment and a macro perspective, it's a slightly more important event than one would like it to be.
All right, Nitin. Before we talk about some of the stocks and sectors, your call on MCX, the pre-open rates are indicating around 1400 kind of equilibrium price, and on top of that, there could be a bit of a uptick on that as well. Is it justified? What's the call now?
As we were talking, I think when you have IPOs of new theme ideas, and this is kind of the first of its kind, I think it's very hard to understand the investor psychology behind these things. So there's clearly a big demand-supply mismatch, given the amount of oversubscription we saw in the IPO. So I think anything can happen today. As I said, we should wait and watch and see how the stock seasons over a period of time. Maybe give it 1 or 2 quarters. Let the market understand their earnings, story over the next 2 quarters based on their quarterly releases, and then I think it'll be a much better, longer-term understanding of the trend. Right now, based on the price that's showing on the screen, it's clearly expensive compared to global peers because that's the only benchmark we have. But as I said, I think it's an unusual situation right now because of the thematic investment idea that people are looking at it as.
And what about the new system? We're in this new phase of listing where you have this 45-minute trading window, and then there's an equilibrium price. And do you think it'll kind of take away the extreme volatility, or do you think it takes away the opportunity? That's the other way of looking at it.
Well, I think it's from the point of view of investors, it can only be good because the last thing you want is for stocks to be 100-200%, moving on the first day in absence of any circuit type situation, especially for stocks that are not in the index. And you rarely will be a situation where the stock listing will be in the index anyway. So I think it's good from the point of view of controlling some of that volatility.
Nitin, what to do with banking stocks now? State Bank of India, after the results, the market sort of ignored the NPA number. The stock went up to 2500, had an equally strong fall back to 2100 or so, and now is rallying again. I mean, it's been quite volatile, but do you think the stock is now pricing in the best possible scenario, or can it rally more?
I think banking clearly is a beneficiary of the interest rate cycle turning around. Obviously, we saw a 30 to 40% rise in almost all banking stocks. Some of them actually rose even more on the PSU side because of the valuation impact. So it's not a bad place to be in for investors. It's clearly there is a certain amount of downside protection into those stocks. There's a lot being made out of the NPA fears, especially for this quarter, given that we saw a fairly large amount of restructuring in a lot of these loans last quarter. But I think from our perspective, it's clearly risk reward is in the favor of being in that sector right now, especially on some of the leading PSU names because valuations are still very, very attractive.
And the other part of the equation, of course, is what's been happening to L&T and BHEL. And, on ground, the order situation still hasn't improved, but the market is focusing on what could happen in terms of rates and what could that mean to some of these companies in terms of their balance sheet. What's the call now?
Right, again, as I said, there was a fair amount of, expecting the turnaround, anticipation of turnaround, the infra, cap goods, real estate, almost everything was outperforming the market in 2 months. So there is a fair amount of reality check that's coming in right now. Having said that, I think if the cycle does turn, which it looks like it's going to turn, it's even CRR cut is actually monetary easing. It's just the first step of monetary easing. I think there's clearly certain amount of expectations built into that stock, especially cap good stocks because they are probably the least impacted from a interest rate cost perspective. So we should wait and watch and see over the next quarter or two how the order book builds up. Clearly, if anything has to be bet on in the interest rate sensitive side, I think that's probably the safest bet right now.
Just in terms of a mix in the portfolio, Nitin, rough ratio, how much should be beta, how much should be defensive right now?
The way we look at it, we are probably more focused on the secular sectors rather than focusing on beta because it's very hard. The problem with beta is you have to time it, and if you can't time it, then there's no point playing beta. So for at least our investment portfolios, we stay focused on where we think there is much more longer term story at play, and I think from that perspective, you can still not get out of consumption. I think consumption still remains the only sector that hasn't seen much of an impact. Yes, it's slowed down, but both government and private consumption is still pretty robust compared to everything else around it. So I think that has to be still the core in the portfolio, and then you.
But how do you play consumption? Because it's such a large umbrella. I mean, you could look at pure play FMCG companies. You could look at these concept stocks which did so well in 2009 and 10. Do you still go back to them, whether it's pizza or whether it's a gym or
I
things
think
like that?
No, again, I think the idea is to look at much more broader definition rather than these narrow niches, because narrow niches tend to get into fair investing valuation cycles. So if you focus on consumer staples, consumer durables, FMCGs definitely, even to some extent things like two-wheelers. I mean those can be labeled as consumption stock ideas as well. But obviously they've seen some slowdown lately. But having said that, I think those are some of the more secular macro themes that we like to play.
And then how big politics is going to be a risk for the market? Because yesterday I was watching some general news channels, and the Trinamool leader, who's a minister in the cabinet, actually comes out and says that it's the best time to go for midterm polls. Then he says, okay, that's not a party stand, but that's my stand. And then he says that, but we firmly believe that any economic reforms now needs to be put on the back burner for the time being. And there's a scenario where Trinamool wants maybe midterm elections. They know that they can improve their tally. SP now maybe wants midterm elections. They can of course improve their tally. So is that a risk which right now the market may be ignoring?
I don't know if having midterm elections is a good thing or a bad thing. I mean, given what we've seen in the last 18-24 months, it may not be a bad thing. Because we haven't anyway seen much happening from a reform perspective. It's been what we call a reform holiday ever since the whole 2G problem came up. So I think the issue is one thing's clear from the UP elections and all the other state elections. The only thing that gets recognized, much like in our business, fund management, is performance. If you perform, you stay. If you don't, you don't stay. And I think that's been a trend pretty much in the last few state elections, in the last whether you look at states like Delhi or Gujarat or UP now, or Bihar for that matter. So I think that's becoming clearer to all politicians. Everything else is rhetoric. Everything else, and again, that's why they say that politics makes for strange bedfellows. So I think clearly everyone is going to look at how they can benefit from the current situation. But keep in mind that every party, actually the manifesto is pretty common anyways. Issue really is how well they can execute, and it's not about what they want to execute, because everybody knows what they need to do to take the economic process forward.
So, and now the related question is what to do with oil stocks and oil marketing companies. The only loser on index right now is BPCL, down about 1.5%. I think for the next 2 years, do we go back to sort of controlled mechanism on oil prices and big losses for some of these companies? And in that case, is it worth buying any of them, or would you stay away now?
I think it's another element of the trillion-dollar question. I don't think we can afford to be in a situation that we are in from an oil policy perspective, because it's not going to help us from a fiscal point of view if we stay in that zone. So we definitely expect some news flow coming out on that front over the next maybe 4 weeks or so. And everything else depends on what the intent on deregulation on the oil price front is. So I think till that point in time, it's probably wait and watch is the best.
So you drive a petrol car or a diesel car? I'm just curious.
We'll talk about that later.
Sure, but in terms of policy, you mentioned the whole 2G situation. So where does that leave telecom? It's been completely out of favor. Bharti has fallen from its highs to what, 330 or something now?
Again, I think there is a fairly high amount of uncertainty on the policy front. Pending the whole new regulation or the new telecom policy, I think it's very hard to take a call on those stocks. One thing is clearer, despite all the 2G problems and the orders on spectrum, I don't think the competitive intensity is actually slowing down, which cannot be good news for stocks, because if in this situation the intensity doesn't slow down, then I don't think you can have any better situation from a market point of view, the end consumer market point of view. So I think it all depends on what the policy states. Till that point in time, it's very hard for us to take a call.
Okay. So just getting back to concepts or areas that you spoke about that you like, you mentioned consumption as one big thing that you are going for. You mentioned two-wheelers, but you didn't talk about the other half of the pack, which is the four-wheeler or passenger side or the CV side. Is that a void right now for you?
I think Maruti, for example, is an exception because there was a lot of pent-up demand because of their strike problems. So there, obviously, there's a fair amount of opportunity investors have seen. Commercial vehicles haven't seen much of a slowdown, especially on the LCV side, even though tractors have. So again, you can take your pick. But effectively, if the interest rate cycle does turn, then I think almost everything is going to be beneficiary. So yes, it is a contra play. Banking I talked about is also a good place to be in right now. Again, we are a little wary of getting into pure beta because, as I said, that's really in expectation or in anticipation.
So metals,
metals also, again, given what's going on globally, I think metals seems like they probably will give you a little bit of a bump up. Now, again, that's a little bit of a dichotomy because metal prices going up isn't really so much good news for us because it will feed into inflation. But, from a beta perspective, it could be a place to be in.
Nitin, what about Midcap IT? There is quite a bit of buzz on what's been happening in Hexaware. You keep hearing about 3i Infotech and First Source. Of course, nothing is happening over there. Sometimes Geometric, keeps propping up. Do you think that nice opportunities here? And some of these companies, for example, Hexaware did come out with good set of numbers as well. So, any opportunity that you sense here?
Again, I think it's very, very specific. It's very, very company specific. Clearly, there's a consolidation wave that is kind of being formed right now. Especially with some of the mid-cap names looking for either buyers or strategic investors, and we've seen some of these deals happen in the last 12 months. So it's very hard to say that there are opportunities around, but yes, you can find some of those opportunities as consolidation picks up. But having said that, I think IT clearly is a defensive play right now, given that currency is still closer to 50 than anything else, and that'll give them a little bit of cushion, even though headwinds in Europe could be a little challenge over the next 12 months.
Just launched a gold ETF, so just talk us to that, and what's the size? And is it going to be different from the kind of products we have already seen?
I think it's actually a very unique gold product, because what we are trying to do is use the ETF platform, but in a way extend the use of ETFs from just pure financial investment product. Also, people who actually have a desire to consume gold, because typically what happens is you can either buy an ETF and get the price linkage to the gold price, so you get exposure to price of gold. But keep in mind that 99% of our gold imports for consumption last year, because that's really where the big $50 billion worth of gold is consumed. In our ETF, what we're basically doing is most gold shares, you have the option of holding in ETF form, or at any point in time actually swapping the ETF units for physical gold. And that basically gives you the ability to then choose whether you want to be an investor or a consumer, and you don't have to choose upfront. As you consume through this route, or as you convert your ETF units into physical gold, you also get the price benefit of actually the spot price that we buy at, because all retail gold price is typically anywhere from 10 to 20% higher than the spot price, given that the retailer margin comes in, whether it's a bank or jeweler. So we are effectively giving investors the ability to buy the ETF and effectively convert that into physical gold at the best possible price that they can find in the market.
Okay, well, so Nitin, final thoughts then, just to sum up the whole conversation that we've had. Go back to that $1 trillion, $1 million question. Next 1 month or so, because April we start rolling into earnings. More chances of the market falling down, or more chances of it moving up? I'll leave it that broad.
And again, I think it's very hard to call next 30 days, especially given that we have a couple of large events that are planned. I would say that while you can see volatility, and we've seen volatility in the last couple of weeks after the markets gave a one-way run, I think there are better chances of us using the opportunities of declines in the market to consolidate our portfolios than anything else.
All right, Nitin, thanks a lot for joining in. Always appreciate your views. Thanks a lot.